Well, hello everybody, and happy Monday. Thank you for having me again. Cooper Thayer here. I am your newly named Chief Market Strategist for the Keller Williams Colorado region. I'm very excited to have an official title now and continue to share these interesting insights and analysis of the data that we get every month in the market with you to help kind of inform your decisions and help you serve your clients best. So let's jump right in and take a look at some of the trends that we're seeing recently in July and year to date. First off, statewide pulse, right? So this is statewide data through July 2025. Not a lot of surprises here, right? A lot of the same themes that we have continued to talk about all year, most notably inventory. There's a big mismatch between the number of new listings coming on the market and the number of listings that we're selling, right? Last year, we had about 14% less new listings come on the market. So this year, new listings are up about 14%, but sold listings are not increasing that fast, only about 1.7% increase year over year. So that has resulted in the number of active listings at the end of last month increasing about 20% over the same time last year. And as we all know, what does that mean? Well, more inventory sitting on the market. We have more supply and more days on market on average for the typical listing to spend before getting a buyer. Now, one of the surprises that we have is the lack of impact that's had on pricing in the single family market in particular. So we can look at, detached or single family homes have actually maintained a nearly flat level year over year in terms of median close price, which for us as in a state where we are used to 3, 4, 5, 6% appreciation year over year, this may seem low, but given the inventory environment that we're in right now, it is extremely positive, in my opinion, to see flat pricing, right? Our single family um, homeowners are not losing equity in their homes because of the flood on the market. Now, unfortunately, of course, the condo townhouse attached markets have not performed the same. If we look at uh, year over year change, we are down about 6% in median close prices, down from 425,000 to 400,000 statewide in the townhouse condo market. And we can really see when we graph it, this kind of divergence of the lines. The green line on the right there represents single family median sale or average sale prices, and the blue represents the townhouse condo attached market. And we are really seeing that kind of correction territory in the townhouse condo market for, I believe, one big reason, and that is HOAs, right? We have seen just a massive increase in the past few years in HOAs. This has resulted in affordability challenges presenting themselves as barriers to entry into the condo and townhouse market, especially in that entry level price point. So, wanted to provide you with some talking points when discussing HOAs with clients, either buyers or sellers, to provide them context. This can really help you out with having some interesting data to back up your themes and your ideas when talking to clients. So, big picture, this is based on all of the closings in the RE Colorado MLS so far this year through July. We had about 60% of all closings in the MLS were in an HOA. And if we look at the average and median HOA dues across all closings, it was about $207 a month on average. $102 a month was the median.
Hey Cooper,
Breaking it. Oh,
sorry.
yep, go ahead.
Sorry to interrupt. I was gonna try to let you know that you're in the presenter screen, so a lot of people are having a hard time seeing you.
Oh, I am so sorry about that.
Nope, it's all good. Just wanted to jump in before you went through
How's
all.
that? Is that better?
Yep, way better. Thank you.
Oh man, you should have warned me earlier. Sorry about that, everyone.
All good.
Yes, breaking it down by property subtype, right? This is where we start to see the big difference, as we all know, but these are great talking points to provide to your clients. Single family averages about $92 a month, median $70 a month. So when looking at it as a square footage basis, single family is only you're only paying about 2 cents per month per square foot in HOA dues on average. Townhouses are about 1.5 times that. I'm sorry. Townhouses are about 10 times that per square foot for HOA dues at about 20 cents a month. Condos are much, much higher. We're averaging about 45 cents per month per square foot in the entire Denver metro area. Downtown, we are starting to see these numbers get up to 60, 70, 80 cents per month per square foot, sometimes even a dollar per month per square foot. So when you think about what that does to affordability, you take a 1,100 square foot two bed, two bath condo, maybe something like that is in the four, five, $600,000 range, but the HOA is $1,200 a month, $1,100 a month. That has a really big impact on buyer affordability. In fact, I just ran an analysis last month that found that at current interest rates, every incremental $100 of HOA dues per month equates to about $15,000 in purchasing power. So for $1,000 a month in HOA dues, which is not uncommon to see in condos, we're looking at $150,000 in buyer purchasing power. That is the explanation behind a 6% downward adjustment in condo sales prices in the past year. In fact, it's a little higher for condos. That includes townhouses as well. If we look at condos only, I'm sure it's a little bit higher than 6%. If you have buyers that want to avoid HOAs, here are some ways that they can do it. In the older housing stock that we have in the Denver metro area, pre 1980, we get higher fees. So when you think about the older condo buildings, especially those built in the 50s, 60s, even the 70s, a lot of them have higher fees. They are more expensive to insure. Some of them have had deferred maintenance and sometimes assessment issues in recent years. But the presence of HOAs, especially in the single family market in that older housing stock, is almost non-existent. And that's where we see a lot of the really niche markets right now performing well, is in that older housing stock, no HOA, entry-level housing. If you think about, if you have clients looking for single family homes in the Denver metro area, I can tell you from experience, there is pretty much only one type of property right now that is super, super hot across the board, which is non-HOA entry-level homes. Think sub 500 in Arvada, think sub 500 in Littleton. Those are the types of homes that are getting tons of attention right now. Now, if you want a newer home, you are going to be in an HOA, right? Presence jumps up to 84 to 87% for 21st century construction, but the fees tend to be a little bit lower, especially in those single family communities. I will say though, one caveat to that is that a lot of those fees have been transferred to metro districts. So they're going to be reflected in your taxes rather than in your HOAs. But some interesting statistics here. And if you've ever seen me talk about HOAs, you know I love this chart because it's just such a kind of a shocking number. But Colorado is the second highest prevalence state in the country for the percentage of residents living in an HOA. 41% of all Coloradans live in an HOA, second only to Florida at 45%. So very interesting. It just shows you how extensive, when we have HOA problems, how extensive that impact can be on Colorado with such a large percentage of our population living in an HOA. All right, now we talk a lot about, as agents, we want to be very positive, but this is a friendly reminder that I think it's really, really important to be very blunt and honest to your clients about the state of the market. And here's a little insight on how I do this. You know, this is a screenshot every single week with every single seller. We're producing videos talking about the market and not necessarily talking about the good things. So the next slides here are going to show you some of the concepts that I like to convey to talk about how important knowing the actual market conditions are right now. Inventory surplus continues to climb. Here's an unfortunate truth. In the United States right now, Colorado may be one of the strongest buyers markets in the country. We have a 55% excess inventory. So that is inventory compared to the long-term average for the month of July. We are 55% higher than our long-term average, tied for number one in the country with Florida. And this has led to tons of price reductions, right? Denver is actually leading the nation this year in price cuts. This data is as of June. We're going to look at July data next, but Denver has, the Denver metro area has experienced price cuts at a higher prevalence than any of the other 50 major metros on this chart. That is significant, right? Sellers are having to concede more and more to attract buyers in the Denver metro market. If we pull back and look at statewide price reduction trends last month, 35.2% of all listings on the market last month had a price reduction. And we can kind of zoom in into county level data and look at where those price reductions were most prevalent. If we look at the red area, primarily in the Denver metro area, we are seeing a lot of price reductions. Jefferson County over 44%, Douglas County over 43%, Arapahoe over 42%. Denver County itself, 40.4% of all listings had price reduction. So this shows you just how prevalent the price reductions are in the market and how important it is to get pricing right the first time. This chart shows really well how important it is to get pricing right the first time. And we're going to talk a little bit more about it. But if we look at the sharp drop off in the percent, this is a net close price, so net of concessions as a ratio of list price based on how many weeks a listing spends in the market. If you can get the pricing right and sell a home in the first week, your buyer on average will only lose 0.8% net off their list price. So including concessions, which are incredibly prevalent right now at over 60% and an average number of $10,800 last month. After that sharp drop off, it's pretty consistently in the 95 to 96% percent of list price received range. So if priced right, sellers can capture 99% of their ask price in week one, but you wait too long, and too long in this case is 1 week, it will cost money. So just reinforcing the cost of waiting for your sellers. And I think if there's one thing to take away from this entire slide presentation today, it's going to be this slide. Okay. The importance of reducing price reductions and why sellers should be more aggressive basically at all costs. Okay. Let's look at properties with a price reduction versus properties without. This is all year-to-date data from RA Colorado. Median days on market for properties with no price reduction, 13 days. With a price reduction, 89 days. That is a huge difference in the time to sell between a property that needs a price reduction that hasn't been priced correctly right off the bat versus one that has. And the speed gap, right, we just looked at how important the first week or first 2 weeks are. Under contract in 14 days. If it had no reduction, 53% of them go under contract in the first 2 weeks. If your listing requires a price reduction, it's not going to happen in the first 2 weeks, right? As we all know. So only 2.8% of listings that have had a price reduction go under contract in the first 14 days, most likely because most of us don't recommend a price reduction until after that 14-day mark. Concessions are also heavily impacted by price reductions. So you're getting hit twice with one price reduction. Not only are you lowering the price, but you're going to probably have more concessions as well. Concessions are more prevalent with price reductions, 67.7% on price reduced listings versus only 60% on non-price reduced listings, and the amount is higher. The median concession for price reduced listings, $5,700 versus less than half of that for non-price reduced listings. But the real penalty, of course, is that net number, right? If we combine all of this data on the left into a net number, the median net to original list after concessions, so what the close price less concessions are compared to the original list price. If a listing does not have a price reduction, it's about 98%. If it has to have a price reduction, 91%. So take this into your conversations with sellers, especially, upfront. A lot of us have a tendency to be very optimistic, and I do this as well, right? We want to please our sellers. We're all people pleasers as real estate agents, but sometimes the truth is more important and is going to benefit your sellers more. You do them no service by telling them that their home is worth something or that the market is better than it actually is, because our job is to support them and get them the most amount of money the fastest possible. And sometimes that means pricing less. Another thing that I've seen a little bit of recently is people will often talk about over asked price listings, right? Sometimes people will cherry pick specific examples as a demonstration of the market as a whole, but it's simply not really the case that a lot of over asking price listings are closing over asking price. About 19.5% of all closings through June sold over asking price gross, but 36.6 of those closings had that premium, that amount over ask price, fully wiped out by concessions, right? And for listings that closed at their ask price, so the close price was equal to the original list price, 63% of those had concessions too. So in actuality, only 12.4% of all closings had a true net over ask price closing figure. That means that you have original list price, less concessions, their close price was higher than that net, or was higher net than their original list price. And we know that concessions are incredibly prevalent right now. Here's a quick update on where we are at in July. We saw the average amount last month at about $10,653. That is for listings with concessions. So the average of listings that had concessions. Prevalence about 61.5%. We've seen concession prevalence remain kind of steady, a little weird throughout the year. It doesn't really follow a trend that I can identify in terms of the number of listings that had concessions. However, the average amount does follow kind of an inverse relationship with close prices, right? If we look at the graph of close prices throughout a year, you'll see it goes up in the summer, peaks in May, June, and then starts to come back down. Concessions follow the opposite trend. So we've seen concessions vary about 12% throughout the year, but concession prevalence has remained fairly steady at 60 to 64%. One more interesting stat is the differences between financing types and how that affects concessions, days on market, etc. Conventional financing, right, as we see in most transactions, about 58% of them, lines right up with that median concession rate, 66%, $10,600. If we look at cash transactions are not having as much concessions. In fact, only about a quarter of the time are there any concessions, and when there are, the average concession amount is about half of what it is in other transactions. They're also obviously selling a lot faster, and the contract to close, that's what the CTC column is, the contract, the number of days from going under contract to closing is notably faster as well for cash transactions. Now, where there's really interesting meat in this table is in FHA and VA financing. We can see that concession prevalence is significantly higher on deals with FHA or VA financing. The FHA, 87% of FHA deals are utilizing a concession right now. That is extremely high. And for VA, it's 76%. And for both of them, that average amount is $11,000. So some pretty interesting statistics for you this month. That wraps it up for me. Thank you so much. Please feel free to reach out with any questions. And again, I am super excited to be your chief market strategist. So keep an eye out, moving forward for some more social media stuff. We'll be putting out reels, videos, and all kinds of interesting statistics moving forward. So thank you all so much.